Hello, class. Welcome to Chapter 10, Making Capital Investment Decisions. The learning objectives for this chapter include determine the relevant cash flows for a proposed project, evaluate whether a project is acceptable, explain how to set a bid price for a project, and evaluate the equivalent annual cost of a project. Again, I've mentioned this in class before, but these chapters continue to build on existing topics that we have previously discussed. So the chapter outline includes a project cash flow, incremental cash flows, pro forma financial statements, and cash flows. Pro forma statements and cash flows are basically, projections, things of that nature. How do you project cash flows? And, I would say the challenge with projecting cash flows is that the further out into the future we go in terms of projecting, the more likely we are to be wrong. Why? There's just so much uncertainty, so many things that could happen. I mean, if you're trying to project cash flows in 2017 for the next 5 years, COVID would have messed all that up, right? If you were an airline running projections in 2006, the financial crisis would have messed that up. Alternative definitions of operating cash flow in some special cases. I will try not to read every word on these pages here, but relevant cash flows and the standalone principle. Effectively, a relevant cash flow for a project is a change in the firm's overall future cash flow that comes about as a direct consequence of a decision to take that project. So, one example I might give you is when Facebook developed their VR headset, they made a cash flow decision. They were going to take cash today and then dump that into their VR headset. Same thing with Apple. They would have, I think in hindsight, easy to say, better off not taking on that project and taking the cash flow. And I'm sure whoever did the pro forma cash flows for Apple's VR headset found themselves to be wrong. Why? Well, because, those things haven't really made a ton of money. Incremental cash flows, the difference between a firm's future cash flows with a project and those without the project. So how much more cash does this make you? Now, if we're again using Apple as an example, when they were projecting the AirPods success or the Apple Watch, I'm sure they ended up a success in giving them much more cash than originally anticipated. Any cash flow that exists regardless of whether or not a project is undertaken is not relevant. The standalone principle is the assumption that evaluation of a project may be based on the project's incremental cash flows. We will primarily be interested in comparing cash flows from this mini firm to the cost of acquiring it. A sunk cost is one that's already been incurred and cannot be removed and therefore should never be considered in an investment decision. It's a sunk cost. Think about, you sign up for a class and you decide you don't want the professor. You don't like the professor for whatever reason, but you already bought the digital copy of the book. In your decision to continue to take that class or get the refund or take it with another professor, you should not consider the sunk cost of the money you already spent on that textbook. Why? Because that's the one part you can't take back. The opportunity cost is the most valuable alternative that is given up if a particular investment is undertaken. Not unusual for a project to have a side or spillover effect for good or bad. Erosion occurs when cash flows of a new project come at the expense of a firm's existing projects. Oftentimes you'll see opportunity cost. One set of opportunity costs is like, hey, what if we put this money in a savings account? We can earn 5% in this market, right? That is often used as an opportunity cost. When I'm looking at my firm and I'm looking at like a new marketing project, my existing marketing, for every $1 I invest, I get $2 in reoccurring revenue. Every other marketing decision, the opportunity cost is my base case. It's what I'm already doing. So when I make a new evaluation of maybe undertaking a new marketing project, my opportunity cost is my existing marketing structure. Projects normally require the firm to invest in net working capital in addition to long-term assets. Projects will generally need some amount of cash on hand to pay any expenses that arise, as well as initial inventories and accounts receivable. Financing costs, another important consideration, especially in today's environment where financing costs tend to be higher than they have been really for the last 15 years. In analyzing a proposed investment, we will not include interest paid or any other financing costs because we are interested in the cash flow generated by the project. The goal in the project evaluation is to compare cash flow from a project to the cost of acquiring that project in order to estimate a net present value, a topic we've discussed in great detail. We are interested in only measuring the cash flow at the time when it actually occurs, not when it accrues or from an accounting sense. This is just looking at cash in the door. We are always interested in after-tax cash flow because taxes are definitely a cash outflow. I will make a comment here, like Netflix is a good example of a business with great cash flow. Why? It's subscription-based, people pay cash, no one's buying anything on credit on Netflix. You're paying that on a monthly basis. They generate a ton of cash. Pro forma statements project the future operations. Here's a little example here. I won't read through it line for line, but it is effectively talking about how we might project an initial investment in a project, looking at the cash flows, what cash this project will kick off, and accounting for taxes as well. This is another one I probably won't read line for line, but it's just showing a projected income statement. You're assuming some level of sales. And again, I think if we use like Apple or with like the Apple Watch or the AirPods, those are pretty interesting to do this as an exercise for, or at least a mental exercise. This is because you can make some kind of assumption, be like, oh, the analysts inside Apple assume like 1 out of 8 iPhone owners will buy an Apple Watch, or 1 out of 4 Apple users will buy AirPods. And then you look at how many iPhones you've sold, and then you just kind of crank those numbers out. To develop cash flows from a project, recall that cash flow from assets has 3 components: operating, capital spending, and changes in net working capital. Net working capital is your short-term assets minus your liabilities, which is similar to the current ratio. That's current ratio is short-term assets divided by current liabilities. Once we have estimates of the components of the cash flow, we will calculate cash flow for our mini firm. And that's basically just a project. So project cash flow, project operating cash flow minus projected change in working capital minus capital spending. Operating cash flow is earnings before interest and taxes plus depreciation minus taxes. And that's the difference. Project operating cash flow, again, this is the Shark Attractant company. And it's showing some sales, the variable and fixed costs, as well as depreciation, the tax rate, and what's left in net income. But then from a cash flow perspective, they're showing that here. You see in year 0, there's an initial lump sum investment in terms of change in net working capital and then capital spending. But then the project continues to kick off cash for a number of years in the future, and then that net working capital is given back. The NPV at the time, at 20%, the NPV at the 20% required return, and it's just giving those numbers here, 20% required return is effectively our discount rate. Based on these projections, the project creates over 10,000 in value and should be accepted. Return on this investment obviously exceeds 20% because the NPV is positive. That's another back of the napkin trick. If the discount rate or the required rate of return is effectively a threshold, right? So if your number is positive NPV and there's a discount rate or required return of 20%, the project's giving off more than that. After trial and error or using a financial calculator, the IRR works out to be 25.8. And the payback period on the project is about 2.1 years. The payback period can be very relevant. It is something I frequently do when it comes to projects I take on. I'll mention my marketing projects again. Why? Because my payback on marketing spending is about 10 months, and my return on it is 2 to 1. Suppose that during a particular year of a project, we have the following simplified statement. Depreciation and taxes are zero, no fixed assets are purchased during the year, and we assume only components of net working capital are accounts receivable and payable. And it shows the difference of those down there and the change in that working capital number. Operating cash flow in this case is the same as EBIT because there are no taxes or depreciation. Thus, it's 190. Net working capital actually declined by 25, which means that 25 was freed up during the year. There was no capital spending. So that total cash flow for the year is operating minus change in net working capital minus capital spending. So that total number is 215. The 215 cash outflow must be dollars in less dollars out for the year. We could therefore ask a different question. What were cash revenues for the year? And also, what were the cash costs? And it shows that down below. A little bit more calculation. I'll try to stop myself from reading it all. We calculate the cash inflow less cash outflows as 470 minus 255, just as we had before. And it gives that breakdown right below. Depreciation, modified ARCs and Macers. Depreciation is a non-cash deductible and has cash flow consequences only because it influences its tax bill. This would be something that I would certainly include on a quiz. It's just a great, I don't want to call it a trivia question, but it's a great knowledge question that could be turned into a great multiple choice question. Accelerated cost recovery programs is the depreciation method under US law, allowing for accelerated write-offs. So you can have depreciation begin at an accelerated rate. Once an asset's tax life is determined, depreciation for each year is computed by multiplying the cost of the asset by the fixed percentage. There's also a salvage value. One area that executives have the ability to heavily manipulate numbers and these costs are through depreciation decisions. If you say your asset depreciates over 10 years versus 5, that is going to have a significant impact on your financial statements. And also investors' assumptions around time on replacement of those assets. Consider an automobile, which normally is classified as a 5-year property, costing $12,000. Based on the table below, we see that the relevant figure for the first year of a 5-year asset is 20%. Depreciation is the first year at 20%. Relevant percentage in the second year is 32%. So depreciation in the second year is 38.40. So this is another accelerated depreciation, or it kind of changes over time. Prior to 2018, bonus depreciation was permitted. Because this is not permitted anymore, there's no sense in going over it. Book value of an asset can differ substantially from market value. We've already talked about this. Anyone who's taken an accounting course knows this. Book value can differ from a market value. So you might depreciate on paper this asset over time, but that's what it's worth on an accounting statement. If you could go to the free market and sell the asset, it could be worth significantly more or less than what you have on the book for it. This is also true in the inverse. We've talked about like McDonald's buying property in the 1960s and how that impacts its book value today, because their assets are effectively depressed because the market value is so different than the book value held on the accounting statements. Macers depreciation. Staples Supply Co. has just purchased a new computerized information system with an installed cost of $160. The computer is treated as a 5-year property. What are the yearly depreciation allowances based on historical experience? We think the system will be worth 10 grand at the end of 4 years. What are the after-tax consequences of the sale? What is the total after-tax cash flow from the sale? The yearly depreciation allowances are calculated by multiplying 160 by the 5-year percentages found on table 10.7. And it goes over that here. And again, I'm not going to read through all the numbers, but notice that we have computed the book value of the system as of the end of the year. Excuse me. This loss, of course, is like depreciation because it's an after-tax expense. What really happens? First, Staple gets 10 grand from the buyer. Second, it saves $3,700 in taxes. So the total after tax cash flow from the sale is 13,000 and change. There are some alternative definitions of operating cash flow. There are different definitions. Keep in mind that when we speak of cash flow, we literally mean dollars in less than dollars out. Gives another equation here in terms of sales costs and depreciation. With these estimates, notice that EBIT is sales minus cost minus depreciation, so that equals 200. Assume no interest is paid, and TC, the corporate tax rate, is 21%. So we have a tax bill of $42. Therefore, operating cash flow as EBIT plus depreciation, you add that back because depreciation is not real from a cash flow perspective. You subtract the taxes because those are real. In this case, that comes out to $758 because taxes paid is a real cash outflow. Again, while depreciation is just an accounting. Bottom-up approach, we begin with the accountant's bottom line, net income, and add back any non-cash deductions. Crucial to remember that this definition of operating cash flow is correct only if there is no interest paid, interest expense subtracted in the calculation of net income. Because we are ignoring the financing expenses, such as interest, in our calculations of operating cash flow, we can write project net income as EBIT minus taxes. And again, for reasons I've said in prior slides, that leaves us with projected net income 158. If we add the depreciation to both sides, we arrive at a slightly different and very common expression of operating cash flow, net income plus depreciation. These terms in like getting these numbers from a math perspective, they're very simple, but from an equation perspective, these would be, again, good quizzable content in a future exam. Top-down approach, we start at the top of the income statement with sales and work our way down to net cash flow by subtracting costs, taxes, and expenses. Leave out any strictly non-cash items. So operating cash flow is sales minus costs minus taxes. The tax shield approach. Tax shield approach views OCF, or operating cash flow, as having two components. What the project cash flow would be if there was no depreciation. It would have been 632. Depreciation multiplied by the tax rate is the depreciation tax shield. Key concept. $600 depreciation saves us $126 in taxes. The tax shield definition of OCF is sales minus costs multiplied by 1 minus the tax rate plus depreciation multiplied by the tax rate. And again, we get that same 758 number. It's just showing us multiple ways of getting there. Some special cases of discounted cash flow analysis. There are 3 cases involving discounted cash flow analysis are particularly important because problems are similar to these, and they're so common. Investments are primarily aimed at improving efficiency and thereby cutting costs. Also thinking about competitive bids, and then evaluating equipment options with different economic lives. You will make these decisions when you go and buy something, even something as common as like furniture for your house. So, again, I try to give simple examples when talking about this, but I remember when I got one of my first apartments that I bought new furniture for. I totally cheaped out on the new furniture thinking I might upgrade in the future. The furniture was not designed to last long. Or you think about, hey, you're going to buy a new TV, and you might say, oh, I'll get a cheap TV so I can upgrade it later, knowing that the cheaper TV is going to have a longer life. Or do you spend up for a nicer couch that's going to have a longer life, or a nicer TV that's going to have a longer life? These are decisions, right? You can also make these with employment decisions. Do you underpay your entry-level employees? And as a business practice, that there's going to be high turnover and you just continue to retrain? Or do you overpay your employees knowing that you'll keep them much longer? And there's no right or wrong answer. It just depends on what kind of environment you want to create. This brings to cost-cutting proposals. So consider we are automating some parts of an existing production process. The necessary equipment costs 80 grand to buy and install, but then going forward, the automation saves 22 grand a year. Assume the equipment has a 5-year life and is depreciated to 0, straight line over that period. It will actually be, we're be worth more than 28,000 in 5 years. Should we automate? The tax rate is 21% and the discount rate is 10. The initial cost is 80 grand, and the after tax salvage value is shown there as 158 because book value will be zero in 5 years. There's no working capital consequences. Buying new equipment affects operating cash flow in two ways. One, we're saving 22 grand a year before taxes. We have an additional depreciation deduction, which remember from the previous slide, the tax shield. And this depreciation is 80,000 divided by 5, and that's $16,000 a year. Because the project is operating income of 22 grand and depreciation deduction of 16, taking the project will increase EBIT by 22 minus the 16. Because EBIT is rising for the firm, taxes will also increase. So you have to take that into account. Taxes increase by about 1260. So you have the EBIT, you add back the depreciation, and then you subtract the taxes to get the operating cash flow of 20,740. We now compute operating cash flow in the usual way. 22,000 pre-tax savings, 17,380. Extra 16K in depreciation isn't a cash outflow, but reduces taxes, 3360. And the sum of those two is 2740, the same number. Here, the relevant cash flows. Again, I won't read these lines. A 10% is straightforward to verify that the NPV here is 8431. So we should go ahead and automate. Again, positive net present value. You should take on that project. To buy or not to buy? Considering there's a $200,000 computer-based inventory management system, the system will save 60 grand before taxes. The relevant tax rate is 21%. Once you have all the data here, and this is giving us an NPV at 16%, or a discount rate of 16%. So first, the after-tax cost savings is 47400. Depreciation is 10,500 per year. So the depreciation tax shield, just breaking that down again, is 10,500. Operating cash flow is at 47,400 plus the 10,500 per year. Capital spending involves 200,000 upfront to buy the system. We see that. And the net change in working capital of 45,000. We also see that below. What this really means is simple. While the system is in operation, we have $45,000 to use elsewhere. You're freeing up capital. So again, if I was flipping this, on my business, we had a publicist at one point. It probably wasn't a good return on assets, but we were looking at other projects, and it had been 6 months. We had spent like $20,000 on the publicist and like the work required to like respond to the publicist's inquiries. And effectively, I was like, well, what if we took that $20,000 and then put it into marketing? Would we be better off? What would that look like? And why? And it shows here that the NPV on this project is negative 4,700. So we would not take that. And it shows the IRR is about 14.4%. So that would be the threshold. So it's below that 16%. You wouldn't take it. Setting a bid price. If a competitive bid must be submitted to win a job, the winner who submits the lowest bid wins. Imagine we're in a business trying to buying a stripped down truck platforms and then modifying them to customer specifications retail. We won't focus on the details here, but let's get into the numbers. Suppose that we can buy the truck platform for 10 grand. Facilities can be leased for 24,000 a year. Labor and materials, 4,000 per truck. Total cost per year will be 24 plus 5 times the 10,000 plus the 4,000 equals $94,000. What price per truck should we bid if we require a 20% return? Capital spending and net working capital, new investment. We must spend $60,000 today for new equipment, and the after-tax salvage value is $39.50. We need to invest $40,000 today into working capital. The lowest price we can profitably charge will yield a net present value of 0 at 20%. Determine the operating cash flow for the NPV equal to 0 by calculating present value of 43,950 non-operating cash flow from last year and subtracting it from the 100,000 initial investment, we get 78,805. Then operating cash flow is now an unknown ordinary annuity amount. The 4-year annuity factor for 20% is 2.55, 58873. This implies that operating cash flow needs to be 30,000 each per year. The final problem is to find out what sales price results in an operating cash flow of 30,442 per year. Recall that operating cash flow can be written as net income plus depreciation. Depreciation here is 60,000 divided by 4 is 15. Given this, we have the net income plus depreciation. Net income is 15,442. And it gives a little math breakdown here of what we're looking for. So if net income is 15,442, then our income statement is as follows. We can solve for sales by noting that sales, net income equals sales minus cost minus depreciation plus 1 minus the tax rate. And that total number ends up being, for the 5 trucks, 25,709, because the 128,546 is the total for the 5. So you want to just divide that. This approach is necessarily, so again, evaluating equipment options with different lives. So you're trying to look at maybe like a cheaper option that is more shorter lived versus a more expensive option that has a longer life. Machine A costs $100 to buy and $10 per year to operate. It wears out, must be replaced every 2 years. Machine B costs $140 to buy and $8 to operate. It lasts 3 years and then must be replaced. Computing the present value of the cost for each machine tells us A effectively provides 2 years worth of stamping services for 117, whereas B provides 3 years worth for 159. Equivalent annual cost is the PV of the project's cost calculated on an annual basis. So at first, the other one seems like more expensive, but when you calculate the effective annual cost, project B it looks to be more appealing when you apply the annuity factor. Selected concept questions. Things we'll discuss in further review before our final exam. What are the relevant incremental cash flows for the project? Explain what erosion is and why is it relevant? What is the definition of a project operating cash flow? How does this differ from net income? Why is it important to consider changes in net working capital in developing cash flows? What is the effect of doing so? What are the top-down and bottom-up definitions for operating cash flow, which will be on a future exam? In setting a bid price, we used a 0 NPV as our benchmark and explain why this is appropriate. That is the end of chapter 10. I hope you all have a great day.